As we near the end of the year, I've been receiving a lot of emails from folks asking me about backdoor Roth IRAs and if I could do a video sort of walking through the things that you should know about them. So here we are. That's what we're going to cover in today's video. And I want to begin just with conceptually what it is. A backdoor Roth IRA is simply a term used to describe a strategy in which you make non-deductible contributions to an IRA and then convert that money into a Roth IRA. Now that doesn't seem too complicated, but it probably raises all kinds of questions like, what is a non-deductible IRA contribution? Is that different from a regular deductible contribution? And why am I even doing this? Why don't I just contribute to a Roth IRA in the first place? Why am I putting it into a traditional IRA first and then moving it over to a Roth? Well, those are some good questions. And to put them in context, I want to walk through some basic background on how some of these accounts work. And I want to start by actually distinguishing between how we go about deducting a contribution to a workplace retirement account, such as a 401k, versus a traditional IRA, because they're different, and it'll actually help us begin to understand a backdoor Roth IRA. So recall, if you make contributions through your employer, it could be a 401k, 403b, maybe you work for the federal government, it's the TSP. I'll just use the term 401k for our purposes. But you make that through payroll deductions, right? You don't even actually see the money. You get your pay stub, you see your gross pay, you cry over all the taxes you have to pay, maybe you pay some health care, and then you see your 401k contribution come out. The employer does it for you and puts it in Fidelity or wherever they keep their 401k. And then at the end of the year, you get your W-2, and there on the W-2, it shows you your contributions. You plug those numbers into your favorite tax software, and it's just deducted for you. And again, I'm talking about a traditional 401k, not a Roth 401k. But with an IRA, it's different, right? There's no employer involved. There's no payroll deductions. You're probably just taking money from your checking account and moving it into an IRA at Fidelity or Schwab or Vanguard or wherever you keep your IRA. No one else knows about it. Certainly the IRS doesn't know that you've done this. And so with a traditional IRA, if you're going to deduct it, you have to tell the IRS. How do you do that? Well, in your tax forms, there's a place to indicate whether you've made an IRA contribution right there on the tax forms, and you can deduct that from your gross income. It reduces your taxable income for the year, assuming you qualify to deduct your IRA contributions. And that gets us to sort of point number two. You can make what are called deductible or pre-tax IRA contributions, and you can also make non-deductible IRA contributions. Now, I want to make clear, when you make the contribution itself, there's no difference between the two. For both deductible and non-deductible IRA contributions, you're doing the same thing, right? You're taking money from your checking account and putting it into an IRA. There's no difference. The difference comes in how you treat that contribution at tax time. So again, with a deductible IRA, you reflect that on your tax returns. Again, your favorite tax software will do this for you, or if you use a tax preparer, they will do that. But in some cases, as we'll talk about, you don't qualify to take a deduction. And so it's described as a non-deductible IRA contribution. Important point, there's actually a tax form you file that tells the IRS, hey, I've made an IRA contribution, but I'm not deducting it. It's non-deductible. Again, your favorite tax software could do that for you, or your tax preparer. But that's the difference between a deductible IRA contribution and a non-deductible IRA contribution. The difference is how you report these contributions in your taxes at the end of the year. And that kind of brings us to the next question. Well, why in the world would someone make a non-deductible contribution? Why wouldn't they deduct it? And the answer is because they may not be able to, depending on whether you are covered by a workplace retirement account. If you're married, whether your spouse is covered by a workplace retirement account, and how much money you make, you may not be qualified to take a deduction for your IRA contributions. You can contribute to the IRA. That's not a problem, assuming you have earned income. You just may make too much to actually deduct that from your income. And I'll show you this. This is the IRS website. They walk through IRA deduction limits for traditional IRAs. You'll see for 2023, if you're covered by a retirement work plan, they take you to this link. It lays it all out for you. And same thing if you're not covered, but maybe your spouse is. There's another page for all of that information. So I'll leave a link to this page below the video, and you can check it out. The point for our purposes is some folks make too much money to actually deduct their contributions. And if they also make too much money to contribute directly to a Roth IRA, then that gets us to the Backdoor Roth IRA. And again, the purpose of it is simply, it's a strategy to allow people who don't otherwise qualify to contribute to a Roth IRA or even take deductions from a traditional IRA. It's a strategy that allows them to sort of, get money into a Roth IRA anyway. It sounds almost scammy, but it's not. And it's pretty straightforward. You make a non-deductible contribution to an IRA. Remember, that's just a regular old contribution, but at the end of the year when you file your tax returns, you don't deduct it, and instead there's a separate form you file that says, hey, I've made a non-deductible contribution to my IRA. And then once that hits your IRA, you then convert it into a Roth IRA. You can call up your broker of choice. They can help you do all of these things. But that's it. It's pretty straightforward and simple. It does sound, though, a little sketch, right? I mean, if we can put it in a traditional IRA, regardless of our income, and then move it over to a Roth IRA, why can't we just put it into a Roth IRA to begin with? Well, there's a little history to this. So the IRA, the traditional IRA, dates all the way back to the 1970s. The Roth IRA, named after the late senator from Delaware, came into existence in the late 90s, 1998, I believe. And when that happened, there was this question at that time, hey, can we convert money we've gotten in a traditional IRA over to a Roth? And the answer then was, yes, but there are income limits. Pesky income limits, right? If you make too much money, they said back then, you can't do it. Well, they ended up changing that. The change actually went into place in 2005, I believe, but it didn't become effective until 2010. And in 2010, the deal was you can go ahead and make conversions from traditional IRAs to Roth IRAs, regardless of your income. Doesn't matter. You could make $100 million a year. You could do a Roth IRA conversion if you wanted to. And some smart people started to think, well, wait a minute. If there's no income limits on Roth IRA conversions, then we could do this whole backdoor Roth IRA idea. We could make non-deductible contributions to a traditional IRA, and then, since there's no income limits on a conversion, immediately convert it to a Roth IRA. Since we've already paid the taxes on this money, remember, it was non-deductible. We didn't deduct these contributions in our tax returns. The conversion shouldn't trigger any taxes. Now, I'll tell you, for a while, there was some concern that the IRS would actually disallow this if it wasn't done right, and there were some suggestions that you should wait some period of time between making the non-deductible IRA contribution and converting it to a Roth IRA. But there were some IRS rulings that sort of put all those issues to rest, and now it's pretty much an accepted strategy for a high-income person to, through the backdoor Roth strategy, get money into a Roth IRA. And that's the strategy. That's sort of the purpose. That's the background. But there are some other questions we need to tackle. And the first is, remember that there are annual contribution limits to any IRA. In 2023, it's $6,500 if you're 50 or older, that you have a catch-up. But we'll just stick with the $6,500 contribution limit. This is important to understand. That limit applies to all of your contributions to both traditional and Roth IRAs. In other words, you can't make a $6,500 contribution to a traditional IRA and then a $6,500 contribution to a Roth IRA. You've got to add up all of your contributions. So in theory, you could split them. You could give, assuming you qualified, you could do this. You could put some in a Roth IRA and some in a traditional, or you could put some in a traditional, I suppose, convert some of it. But the point is there are annual contribution limits, and non-deductible contributions to an IRA count towards that annual contribution limit. Now, you may be thinking, okay, I get that. If I put $6,500 into a non-deductible to an IRA, and whether I deduct it or not, I've met my limit. If it's non-deductible, can I move it over to a Roth? I've already used up my contribution limits of $6,500 this year. Do I have to wait till next year to convert it over to a Roth? No, because the annual limits are limits on contributions. Once the money's in an IRA and you move it to a Roth, that's not actually considered a regular contribution. It's actually considered a conversion contribution. We'll just call it a conversion. And you can convert dollar-wise as much as you want. There are no income limitations. It's only for contributions. But I point this out because what you cannot do is make a $6,500 IRA contribution to an IRA and deduct it at the end of the year, and for the same tax year, make another $6,500 contribution that's non-deductible, that you don't deduct, from your taxes to convert to a Roth. That will get you into trouble. So just keep in mind, annual contribution limits apply. Now, the next big gotcha is what is referred to as the Pro-Rata Rule. Let's imagine that you're going to do this backdoor Roth IRA, but you already have a traditional IRA with money in it that was deducted, or it could be a rollover IRA, and it's sitting over here in a different account. So you think, well, I'm just going to leave that alone. We'll say it's $100 grand. We're just going to leave that alone. I'm going to open up a brand new IRA, maybe even a different broker, and I'll put my non-deductible contribution into this one over here, and that one I'll convert. We don't even need to think about this one over here, right? Well, unfortunately, that won't work, because what the IRS says is, you know what? We treat all of your IRAs, your traditional IRAs, as one big pot of money. We don't really care if you keep them in Fidelity, Schwab. You could open up 37 different traditional IRAs. We don't care. We're going to treat them all as one big pot of money. So what that means is you can't just pick and choose which of those dollars you're going to convert. You can't say, well, I've got a lot of deductible dollars, pre-tax dollars in my IRA account, but I'm only going to pick out the non-deductible dollars that I just contributed to convert. No, the IRS says, no, not so fast. We're going to prorate this. So we're going to take whatever the total pot of money is, and we're going to say what percentage of it is pre-tax that you've taken the deduction for, and what percentage is non-deductible. And if you can, every dollar you convert, we're going to apply that percentage. So some percentage of it's going to be non-deductible money going over that doesn't trigger taxes, and some percentage is going to be pre-tax or deductible contributions you made that will trigger taxes. So what's the practical implication for this? If you have a lot of pre-tax money in an IRA, a backdoor Roth effectively is probably not going to be that helpful to you, because the conversion is going to trigger a lot of taxes for you. And that's been a problem for my wife and I. I suppose it's a good problem to have, but we have a lot of pre-tax dollars in IRAs, and for that reason, we've never done a backdoor Roth IRA. I know, it's sad. Okay, Pro-Rata Rule. Keep that in mind, very important. Now, next thing. You may have heard of a mega backdoor Roth. And I got to tell you, if a backdoor Roth is good, a mega backdoor Roth has got to be even better, right? And it kind of is, but it may not be available to everyone. The idea here is that you're going to use a 401k or other workplace retirement account. Some of them will allow you to make after-tax contributions on top of the pre-tax contributions you're already making. And while you're still working there, either roll them over into the Roth 401k that your employer may offer. And again, since they were never deducted, that shouldn't trigger taxes. In some cases, you can actually move them over into a Roth IRA. However, not all workplace plans allow this. And once again, very sad, my wife and I have never worked at a job that's allowed us to do any of this. So we've never done a mega backdoor Roth conversion, but I wanted to mention it to you. It's another strategy that can effectively do the same thing with even more dollars. But again, you're kind of at the mercy of your employer and what the terms are of their 401k plan. Certainly, you can ask HR or the 401k administrator in terms of what's allowed. Now, next point. We talked about the backdoor Roth IRA, and you've probably heard of Roth Conversions, and they seem similar, and they kind of are. The backdoor Roth IRA is a Roth conversion, right? When people, though, use the terms, they use them differently. So the idea is a backdoor Roth IRA, as we've discussed, the concept is you're converting non-deductible dollars. Money you've put into an IRA, you can't take a deduction for it because of your income, and you just convert it right over to a Roth, and there are no taxes. When people refer generally to Roth conversions, they're actually referring to taking pre-tax dollars and converting them to a Roth and going ahead and paying the taxes. It will trigger taxes. But often that can be a very valuable strategy if the amount of taxes you're paying at the time of the conversion are, you believe, going to be a lot less than, or maybe even the same or a little bit less than the taxes you would pay if you left it in the IRA and took it out, years later in retirement. So it's an important strategy to understand. And there are similar principles between a Roth conversion and a backdoor Roth IRA, but they are different strategies. Again, the big difference being a backdoor Roth IRA converts non-deductible dollars. A Roth conversion converts pre-tax or deductible dollars and, of course, triggers taxes at the conversion. And that raises yet another question. Well, what if you convert both? Like, for example, maybe you do already have a traditional IRA, but maybe you don't have much in it. So you got $1,000 in your traditional IRA, and you're going to make non-deductible contributions this year of $6,500, and you just want to convert the whole thing. Can you do that? Sure. There's no reason why you couldn't. And in fact, if you said, I don't want to do that, I only want to convert $6,500 because that was my non-deductible portion. Remember that pro-rata rule, some of that would be taxable. They'd view some of those deductible dollars as part of the conversion. But let's say, yeah, forget all that mess, Rob. Let's just convert the whole thing. I'll pay the taxes. You can absolutely do that. You won't pay taxes on the conversion of the non-deductible dollars. As for the deductible contributions in our hypothetical, $1,000, that would be added to your ordinary income in the year of the conversion. Now, the last point before we get to the value of doing this, and that is keep in mind that a backdoor Roth IRA is, as I mentioned, it is a conversion. You're putting money in a traditional IRA and then you're converting it to a Roth, and therefore the 5-year rule on Roth conversions applies. I just did a video on this. You can check it out in the channel, but effectively it says that in order to avoid the 10% penalty for early withdrawals, you got to let 5 years pass. And that 5-year rule on conversions applies to each and every conversion you make. You can make one each year for the next 10 years, and each one's going to trigger a new 5-year rule. But there's a lot more to it than that. Again, check out the video on the channel if that's important to you. Now, finally, if you've lasted this long, thank you. So, is it worth it? Is it worth all this hassle? Well, I put together a simple spreadsheet. And what I assumed, let me make this a little bigger for you if I can, maybe. There we go. So I just assumed that we were going to do this for 20 years. Obviously, you could put in here whatever you wanted. I assumed we'd earn 9%. I assumed a tax rate of 20%. So that's 15% long-term capital gains at the federal level, 5% at the state. Again, your mileage may vary depending on where you live. And so if we put in here, let's assume $6,500, which is the current annual contribution limit, not including the catch-up. And hopefully this works. There we go. So what have we done here? So I've calculated the future value, assuming this 9% return. This is the formula I've used for just a future value formula. And of course, we know if we follow all the rules, we don't take this out until we're in retirement. It's a qualified distribution. We don't pay any taxes on it, so we end up with this amount of money. If we don't do a Roth IRA, backdoor Roth IRA, and then we just say leave the money in a taxable account, well, we have the same value at the end, and I'm assuming the value would actually be a little lower than this, right? Because you'd pay taxes on the dividends and interest, but I'm ignoring that for a moment. So what would be our taxable gain? Well, I stripped out, in this case, what is that? 6,500 times 20, it's 130 grand. So that's our taxable gain. We apply the tax rate that I've put in here, and that gives us our tax bill of $40,500 and change. And so we're left with $292,000. So it's about roughly a 10% reduction over using the backdoor Roth. And of course, if there were spouses involved and you could double this number, you could each contribute $6,500 a year to a backdoor Roth. The numbers get bigger, of course, $665 versus $584. And so there you go. I do think, again, there's a lot of assumptions here, including this length of time. For all I know, maybe you're going to keep the money in there longer, keeping in mind that with a Roth IRA, there are no required minimum distributions. In any event, the point is, I do think the backdoor Roth IRA strategy can be very valuable, can save you a fair amount of taxes at the end of the day. Obviously, you could run a simple spreadsheet like this. And in fact, I'll leave a link below the video to that spreadsheet. You can just copy it and play with the numbers yourself and maybe even improve on it, I'm sure. So there you go. Hopefully that helps you. I'm sure I've missed some things. I'm not a tax expert. I read a lot about this stuff, but please check with your tax professionals to make sure you do all of this right, because even seemingly small mistakes can cost you a lot of money. I don't want that to happen to you, so make sure you consult with a tax expert before you make any big decisions. And there you go. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.